Past couple weeks have been pretty crazy, especially with the escalation between Ukraine and Russia. As they say, there are no winners in war. My thoughts go out to the people in Ukraine having to deal with this whole situation that they've been put in. But I did want to talk about how this may affect the stock market, as we've seen a lot of volatility, how things may shake out going forward, and then also briefly talk about my own portfolio and what I've been up to the past month. So the past couple weeks, we have been getting updated information around Ukraine and Russia. What's interesting is there was actually articles back in December talking about a possible conflict starting based on the buildup of troops, but not until a couple of weeks ago did we really start hearing more news about it, as it seemed like there was going to be an invasion. And the worst of it came Wednesday night when Russia finally announced that they're going to invade Ukraine. Futures were blood red, and that morning was extremely red. But then throughout that day, I think surprising pretty much everyone, we rallied pretty hard. And people may be scratching their head, what's going on with that rally? Why after an announcement that there's going to be more conflict would we rally? And we'll get into that. If you've been investing for a long time, the market does not like uncertainty. And with these geopolitical events, there's a lot of uncertainty of what's going to happen. So when the event actually happens, usually there's more clarity in the market and it can digest what is the impact of Russia invading Ukraine. This isn't the first geopolitical event that the stock market has gone through. There's been a lot of terrible events that have happened throughout its history, and there's usually a drawdown. The average is around 5%, but eventually the market recovers, and the average recovery period is around 43 days. I think the biggest thing for the US stock market was the decision of whether or not the military was going to get involved. Because Ukraine isn't a NATO country, technically the US doesn't have any requirements to get involved other than wanting to support a nation that's being invaded and trying to defend itself. Because Putin made it very clear that anyone that got involved would have terrible consequences. Basically like wink wink, we will probably nuke you or start a nuclear war. I think everyone obviously wants to avoid that. The second takeaway from Joe Biden's speech was that sanctions were being used to de-escalate the situation from going further. They held some things on the table just in case if Russia decides to make other moves. The US also basically said they're going to send extra troops to NATO countries on the border of the situation. Essentially, yeah, if Russia did something to a NATO country, then the US could get involved. But as of now, it's just sanctions. Now, the Russian index is a different situation. I mean, the thing crashed around 30% Thursday morning. It's having a bit of a dead cat bounce, but this thing is trading like a penny stock. And this is like the equivalent of the S&P 500 for the US trading like a penny stock. So these moves are massive. Obviously, Russia is getting hurt by these sanctions, and it will probably hurt their economy. And the hope is that Putin backs off based on all of these sanctions. What's interesting is if you look at the revenue percentage that comes from Ukraine and Russia from S&P 500 companies, it's only around 1% of the revenue. So actually, it's a very small impact to any companies in the US and people investing in something like the S&P 500. If you look at individual companies, here are some of the companies with the highest exposure to these regions. And number one is Philip Morris. So I guess more people smoke cigarettes there. Across the board, these companies do have a higher percentage exposure than your average 1%. Also, to be fair, we have other stuff going on in the stock market that would cause a drawdown, right? We have the interest rate hikes on the horizon in March, inflation fears. There's a lot of stuff that isn't related to Russia and Ukraine that can bring the stock market down. So blaming everything on this situation doesn't make a ton of sense. Based on all of that, I think the market is honestly looking more to the Fed and what Jerome Powell is going to be doing. Of course, if there's further escalation with the situation, let's say Russia does invade a NATO country, then yes, I expect more volatility. The market's not going to like that. But for now, if everything kind of stays within Ukraine, then I think the focus will be more on Jerome Powell and the Fed. Because there's an expectation that yes, there will be an interest rate hike in March, but the likelihood that it's going to be a 50 basis point move may have been lowered based on the uncertainty and the fear in the markets due to this geopolitical risk. In the short term, I think we could run up to around 355 on the NASDAQ, but I think there's a lot of resistance there as we've established a downtrend. So the market needs to break this, in my opinion, in order to move higher. So we may go up to 355, bounce back to this important 340 level, and then make a move higher once we get more information around the interest rate hikes and everything else calms down. So those are my thoughts on the general market. But if we look at by sector, which ones might be affected more, one of those would be oil, just because of the amount of exporting that Russia does for oil is a lot for the world. So if that dries up, the supply side goes down, then the price of oil would go up everywhere. And we saw that briefly. Oil was above $100 and then it dropped closer to 90 again, but that is definitely a concern when it comes to the energy market. You also have defense names like Lockheed Martin that maybe got a bit of a bid with all this going down, but we do have to remember that I don't think there'll be any major impact to their revenues unless, of course, the US goes to war, which I think everyone is trying to avoid. The other sector that jumped up quite a bit was cybersecurity stocks, with Russia threatening cyber attacks against other nations. And here are some thoughts from one of the best investors of all time, Warren Buffett, around war and investing.
It could be even a World War III situation. It could be a return to the Cold War. Does any of that ever go through your mind?
Well, if you tell me all of that's going to happen, I will still be buying the stock. You're going to invest your money in something over time. The one thing you could be quite sure of is if we went into some very major war, the value of money would go down. I mean, that's happened in virtually every war that I'm aware of. So the last thing you'd want to do is hold money during a war.
As for a quick update on my own portfolio, currently sitting at 54,954, definitely also getting hit with the overall market. In terms of activity over the past month, I haven't been too active. There's only 2 stocks that I've bought, one being Google. I love their earnings. I made a whole video on Google if you want to check that out. And then also been buying Pfizer. This is more of a value play, and I want some more exposure to healthcare to be around 5 to 6%. And right now it's around 4.5%, but Pfizer is a newer name that I've been adding to this past month. In regards to changing my overall investing strategy based on these geopolitical events, I really don't. I see this as a lot of short-term volatility, but for the long term, my investing strategy doesn't change. If you guys did like the video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.